Welcome back to UK Property Info. If you have been watching the property market over the past few months, you have probably noticed something remarkable happening across the country. Sellers who were once holding firm on ambitious asking prices are now cutting those prices at a rate we have not seen in years. Properties that sat on the market with confident valuations are suddenly being reduced by tens of thousands of pounds. And this is not just happening in one region or one property type. It is happening everywhere, from terraced houses in northern towns to detached homes in the leafy suburbs of the southeast. Today I'm going to explain exactly why this is happening, what it means for the market, and whether this represents a genuine opportunity or a warning sign of things to come. Let me start with the numbers because the data tells a remarkable story. According to the latest figures from major property portals, over 40% of all properties currently listed for sale in the United Kingdom have had their asking price reduced at least once since being put on the market. That is nearly half of all homes for sale, carrying a price that the seller originally thought was too high. In some regions, that figure climbs even higher. Parts of the southeast are seeing reduction rates above 50%, meaning more homes have been reduced than are still at their original price. This is a dramatic shift from the market we saw just 2 years ago, when properties were selling within days, and buyers were offering above asking price just to secure a home. The obvious question is, what has changed? And the answer begins with interest rates. When the Bank of England began raising rates in late 2021, few people expected how far and how fast those increases would go. Base rates climbed from historic lows of 0.1% to over 5% in the space of less than 2 years. For mortgage borrowers, this translated into a dramatic reduction in purchasing power. Someone who could comfortably afford a £300,000 mortgage when rates were 2% suddenly found themselves able to borrow only £200,000 at current rates. The monthly payments on higher borrowing simply became unaffordable for millions of potential buyers. This single factor has done more to reshape the property market than anything else in the past decade. But interest rates alone do not explain the full picture. We also need to understand what happened to seller expectations during the pandemic years. Between 2020 and 2022, property prices in the UK increased by roughly 25% on average, with some areas seeing gains of 40% or more. Homeowners watched their properties appreciate by tens of thousands of pounds without lifting a finger. When they came to sell, many priced their homes based on this extraordinary growth continuing, or at least holding steady. They looked at what their neighbour sold for last year and added a bit more for good measure. Estate agents eager to win instructions often encourage these optimistic valuations. The result was a market flooded with properties priced for conditions that no longer exist. The collision between buyer affordability and seller expectations has created what we are now witnessing. Buyers simply cannot pay the prices that sellers want, no matter how motivated they might be. A young couple who have saved diligently for a deposit and earn good combined salaries still find themselves unable to afford properties that would have been within reach 3 years ago. Their mortgage broker runs the numbers and delivers the sobering news. Their budget has shrunk by 20 or 30% compared to what it would have been before rates rose. Multiply this scenario by millions of potential buyers across the country, and you understand why so many properties are sitting unsold. Sellers who want to actually complete a transaction have no choice but to reduce their prices to meet the market where it actually is, not where they wish it would be. The regional picture reveals interesting variations in how this dynamic is playing out. London and the southeast, traditionally the most expensive markets, have seen some of the sharpest corrections. Properties in outer London boroughs that were listed at £500,000 are now being reduced to £450,000 or lower. The premium that buyers were once willing to pay for proximity to the capital has diminished as remote working has become permanent for many professionals. Why pay London prices when you only need to commute twice a week? This question is reshaping demand patterns across the country. Meanwhile, areas that saw enormous price growth during the pandemic, places like Devon, Cornwall, and the Lake District, are experiencing their own corrections as the rush to rural locations has cooled and the reality of limited local employment has set in. The north of England tells a different story. While price reductions are certainly happening, the scale is generally smaller than in the south. Properties in cities like Manchester, Leeds, and Newcastle, that were already more affordably priced relative to local incomes, have held their value better. The ratio between prices and earnings was never as stretched as in London, meaning the affordability squeeze has been less severe. Buyers in these markets can still find properties within their budget, even if that budget has shrunk. This regional divergence is creating a two-speed market, with southern sellers facing much more pressure to cut prices than their northern counterparts. Estate agents on the front lines are watching this unfold with a mixture of frustration and resignation. Many tell me privately that the biggest challenge they face is managing seller expectations. Homeowners come to them with memories of the 2021 market, expecting bidding wars and quick sales at premium prices. The reality is that the average time to sell has stretched from weeks to months. Properties that are overpriced simply do not generate viewings, let alone offers. Buyers have become extremely price sensitive and will not even bother viewing a property they perceive as overvalued. The internet has made comparison shopping effortless, and buyers can instantly see that a similar house down the road is priced £20,000 less. In this environment, the only strategy that works is realistic pricing from day one, or subsequent reductions until the market responds. The question many people are asking is whether these price reductions represent a buying opportunity. The answer depends entirely on your personal circumstances and timeline. For first-time buyers who have been priced out of the market for years, the current conditions offer a genuine window of opportunity. Sellers are more willing to negotiate than at any point in recent memory. Properties that receive no offers at their reduced price may accept even lower bids from serious buyers. The power dynamic has shifted decisively from sellers to buyers, and those who are ready to move can take advantage of this. However, this comes with an important caveat. Nobody knows how far prices will fall or how long the correction will last. Buying now might mean purchasing something that continues to decline in value for another year or two. For existing homeowners looking to move, the calculation is more complex. Yes, you might have to accept less for your current property than you hoped, but you will also pay less for your next home. In a falling market, chains can work to everyone's advantage because both transactions happen at lower price points. The danger comes when sellers refuse to accept the new reality. I have seen chains collapse because one party insisted on an unrealistic price while expecting everyone else to give them a discount. The sellers who are successfully moving are those who price realistically and negotiate flexibly. Pride about what your home is worth on paper matters less than actually completing a transaction. Investors and landlords face their own dilemmas in this market. Rental yields have improved as prices have fallen, while rents have remained strong. A property that offered a 3% yield at its 2022 valuation might now offer 4 or 5% at current prices. For cash buyers, or those with substantial deposits, this makes investment properties more attractive than they have been in years. However, the regulatory environment for landlords continues to tighten, and the era of easy capital gains appears to be over. Anyone buying investment property now needs to focus on rental income rather than price appreciation. The days of buying anything and watching it double in value over a decade are likely behind us. Looking at the broader economic picture helps explain why this correction may have further to run. Inflation remains above target, suggesting interest rates will stay elevated for longer than many hoped. The cost of living crisis continues to squeeze household budgets, limiting how much people can save for deposits or afford in monthly payments. Unemployment, while still low by historical standards, has begun to creep upward as companies respond to economic uncertainty. None of these factors support a quick recovery in house prices. The most likely scenario is a prolonged period of adjustment, where prices gradually drift lower or remain flat while incomes slowly catch up. The explosive growth of the pandemic years is not returning anytime soon. The new build market deserves special attention because it faces unique pressures. Developers who bought land and made planning commitments based on 2021 prices are now struggling with the mathematics of their projects. Building costs have increased substantially due to materials inflation and labour shortages. At the same time, the prices they can achieve for finished homes have fallen. This squeeze on margins has caused some developers to pause projects entirely, while others are offering unprecedented incentives to buyers. Contributions towards stamp duty, help with mortgage costs, furniture packages, and other sweeteners are becoming standard as developers compete for a smaller pool of buyers. First-time buyers in particular can benefit from these incentives, effectively getting more home for their money than the headline price suggests. What should we expect for the remainder of this year and into the next? Based on the data I am tracking, price reductions will likely continue through the autumn and winter months. The seasonal slowdown that typically affects the market during the colder months will add additional pressure on sellers who need to complete transactions. Those who have already reduced prices once may need to reduce again if their properties remain unsold. The spring market next year will provide a clearer indication of where prices are settling, but I would not expect a return to growth until interest rates begin falling meaningfully. That may not happen until late next year at the earliest, and even then, rates are unlikely to return to the ultra-low levels we became accustomed to over the past decade. For those of you watching who are trying to navigate this market, my advice is straightforward. If you are a buyer, you have leverage that has not existed in years. Do your research, understand what properties are actually selling for rather than asking prices, and do not be afraid to make offers below asking. Many sellers will accept less than they are publicly advertising. If you are a seller, price realistically from the start, rather than testing the market with an ambitious figure. Every week your property sits unsold is a week when buyers are wondering what is wrong with it. The stigma of a stale listing can be worse than the stigma of a price reduction. If you are an investor, focus on cash flow and yield rather than capital appreciation. The properties that make sense today are those that pay for themselves through rent, not those requiring future price growth to justify the purchase. The current market represents a significant reset from the exceptional conditions of recent years. Prices that seemed normal during the pandemic were actually the products of extraordinary circumstances. Record low interest rates, forced savings during lockdowns, and a sudden revaluation of space and location. Those circumstances have reversed, and the market is now adjusting accordingly. This is not a crash in the dramatic sense, not a sudden collapse that wipes out values overnight. It is a grinding correction, property by property, as sellers gradually accept that the market has changed. The sooner sellers embrace this reality, the sooner they can move on with their lives. Those who resist will simply watch their properties age on the market while prices continue to drift lower around them. Thank you for watching this analysis from UK Property Info. If you found this breakdown valuable, please subscribe to the channel for regular updates on the UK property market. Hit the notification bell so you never miss a new video. Share this with anyone you know who is buying, selling, or simply trying to understand what is happening to property prices across the country. Leave your comments below, telling me about price reductions you are seeing in your local area, because your observations help build a complete picture of market conditions nationwide. Until next time, this is UK Property Info, helping you make sense of the property market one video at a time.